Hello, and welcome everybody to the BTI Market Outlook Client Service Review webinar for 2014. We're delighted you were able to join us this afternoon. It is noon or just afternoon here. We are broadcasting from just outside of Boston in the suburbs in Wellesley, Massachusetts, and it is 38 degrees, so many of you are thinking, my, that's cold, while another group of you are thinking, my, that is so warm. But either way, we're delighted to have you. We've got about 660 people joining us today in total, and we are got folks from the Americas, from Europe, from Asia, and we're delighted to have all of you. We're going to be covering a lot of material today, and what I'd like to do is just kind of share a couple of things. First, I am Michael Reinowesser. I'm the president of BTI, and I started BTI about 25 years ago. I will be joined in a couple of minutes by Jennifer Petrone, who is a principal at BTI. Jennifer will have the much more difficult job than I do today. Jennifer will be answering questions, and you'll hear from her in just a minute about how to answer questions and how that process will work. For those of you that would like a copy of the presentation, we will have a copy available about an hour after we finish, so everybody on the call today and on the web broadcast will be getting a copy of the slides, so hopefully that will impact some of your note-taking and planning for the event today. And with that, what I'd like to do is remind you that at the end of the webinar, we will be sending you an email, and that will have an evaluation, and we would very much appreciate your feedback. And that same email will have a link so that you can download the recording and review it so that you can look at it privately, make notes, and share it with your staff if you'd like. So what I'd like to do is turn this over to Jennifer. Most of you know Jennifer. If not, Jennifer has been with BTI for just about 10 years now, helping us develop our research and honing our new research as we plan some new research initiatives and have introduced some new things over the years. So I'll turn it over to Jennifer for a couple of minutes, and we'll talk about how to do question and answers. Jen?
Excellent. Well, thank you, Michael. As Michael mentioned, I will be responding to questions throughout today's presentation. So if you have any questions about the data that we're talking about, BTI in general, or any of our other research, I do encourage you to go ahead and ask. Now, due to the high number of participants on today's call, everyone is in listen-only mode. So in order to ask a question, we are going to be using the chat ask a question feature that is located in your sidebar panel. So on the right-hand side of your screen, you should see a sidebar panel. And if you have minimized this already, you can reopen it by clicking on the red arrow that's there. You will see a comment box just under the chat ask a question feature. You can just enter your questions or comments into that box and click send. Your questions will be delivered to us privately, and we will respond to you as quickly as possible. Also, if you have any questions or thoughts following today's presentation, we welcome you to call or email us directly, and Michael will be sharing that contact information with you at the end of the presentation. So with that, I look forward to answering everyone's questions, and Michael, I will turn it back to you.
Well, thank you, Jen. And what I'd like to do is start out by just reminding everybody what the source of the data is. At this point, we're going to be drawing on our research with 4,000 corporate counsel. As many of you know, these are in-depth interviews. They're not online surveys. There's one-to-one contact. The average length of time of each interview is about 42 to 44 minutes. So there's a lot of probing, a lot of interaction. We do not pay any of the participants. What we do is we provide them with a detailed benchmarking report talking about how General Counsel manage their departments. And this has, over the last 13 years, become a very popular document. And we use that to compensate and encourage the corporate counsel to share their most specific, sensitive, and detailed information with us. We also have some information that you'll see in some analysis based on interviews with leadership partners and leadership individuals from major law firms and 200 top business executives who are in a capacity to hire law firms but are not necessarily in a corporate counsel function. They are in a business function. Some of those will be from privately held companies and other organizations or divisions, and typically are hiring for things like M&A, litigation, and intellectual property, as well as labor and employment in particular. We pull all that together, and we really focus on trying to find out what's happening both in the client service world and client service performance, but also in the market in general. Our goal is to help our clients drive higher growth even in a flat or tough marketplace, boost client retention, and improve profitability while they're in fact doing that. So I'd like to start by taking a 30,000-foot view and see what we can learn from that, because the messages from this year's research really start at the top. You can see the U.S. legal market is just over $100 billion in spending. About $60 billion of that, or 60%, is being spent on outside counsel, that is being spent with law firms. The remainder, the 40%, is being spent internally by corporate legal departments. So you've got about a 60-40 split in how the dollars get divvied up in the corporate legal world with larger clients. The first thing we noticed when we looked at this and started looking at the history is this number has actually changed fairly significantly. If you go back to 2011, the amount corporate counsel were spending in-house was approximately $33.5 billion. In 2013, they closed out the year by spending about $39.8 billion. We'll talk about that. We'll call that $40 billion just to conversation's sake. So what you've got is a roughly $6 billion increase in 2 years over the prior year's spending and investment in in-house resources. Now, this is the first signal that there's some really fundamental change going on in the office of the General Counsel, because when they start bringing spending in this magnitude in-house, they're really looking to make some substantive changes. And some of the reasons that we've heard for bringing this spending in-house are, number one, there's much more talent out there than there used to be in terms of partners who have left big law or medium law and weren't really available to the large companies to bring in-house. The second reason we heard is that corporate counsel are really looking for different kinds of things, looking for more value. So in order to do that, they're bringing more expertise in-house, especially in the area of IP prosecution, IP monitoring, contracts, some aspects of litigation. But what we've found when we've looked at trends over the longer term is many times this movement of spending in-house is often more temporary than not. We don't expect this to continue at this pace for the next 5 years. However, it still presents an opportunity, because those law firms that sit down and work with their clients to talk to them about what they're bringing in-house, why they're bringing it in-house, how can they help transition in new people, how can they provide resources and training to the individuals that they're bringing in-house and make things smoother, are really positioning themselves to get more business as clients think about how they're going to allocate work amongst their law firms, and will also probably make themselves pretty good friends with the new people that they bring on board, that clients bring on board. So we think that there's an opportunity that gets born out of this, and the fact that they brought so much spending in-house says that there may be some real opportunities to talk about with clients about why and the reasons that they're not using outside counsel, which will give you as an outside law firm the kind of feedback you need to reposition yourselves and tap into that thought process and start to make these dollars flow the other way. Now, the interesting news about spending isn't just in the in-house shift. We also noticed that there's a fairly significant difference in spending developing amongst the Fortune 1000 that are what I'll call U.S.-centric versus the Global 500, and in fact, virtually all globally oriented companies in general. As you look at the chart on your screen, what you can see is the spending with the U.S.-centric Fortune 5000 has moved from being roughly 55 or 56% of total spending down to 50% in 2013. And that slow descent has kind of been eating away and putting pressure on the marketplace. But if you look at the blue line, you see a different story. Global 500, and again, this expands out to virtually all companies that are aggressively trying to think globally. So this would even include your middle market clients that are trying to expand into other countries. Generally, we find that this trend will be true in any company that is trying to do business in 3 or more countries. So if they're trying to do business somewhere in Europe, somewhere in Asia, they're probably going to be more following this trend. And what we found is that these global companies have been increasing their spending, and what they're doing is these global companies generally are more aggressive in building out their corporate infrastructures, their competitive infrastructures. They're building plant and facility. They're being more aggressive with their intellectual property assets. They have more labor and employment issues, not necessarily bad or issues that are causing problems, but as they grow and as they add to their resources, both in the United States and around the world, they're facing these issues as they try to expand their businesses. So we found that their spending generally has been increasing, and increasing at a fairly significant rate. So what this tells us is when I look into my client base and I see which of the clients are really trying to expand aggressively or thinking about moving in a global manner versus those that are much more U.S.-centric, I'm more likely to find the growth opportunities in those globally oriented companies. What that means, of course, is that we shouldn't abandon any client, but when we're looking at places where it might be easier, relatively easier, to capture more spending from clients, it's easier to get that from those clients that are increasing their spending and increasing their budgets, which generally is happening with those global companies. So again, even though it's a flat marketplace, there's some interesting opportunities that evolve if we can spot them and figure out how to take advantage of those. As we're thinking about these global companies, it's also important, I think, to see that when we look at the decision-making, many of the large global companies who are not based in the U.S. but still have significant U.S. operations have undergone a trend where they're giving tremendous decision-making to U.S. General Counsel and to the business units in terms of key legal issues. So some of the hiring has become more decentralized on a global basis, and that's offering opportunities to law firms. Interestingly, the hiring by these global companies, roughly 75% when you count it on the basis of matters, have been, the law firms that have been hired have been outside the AmLaw 50. So what you're seeing is certainly for global issues, for large-scale enterprise, they're probably going to gravitate to the larger firms. But there's a significant amount of work going to firms outside the AmLaw 50, and these deal with necessarily issues that are smaller than the enterprise, but could be fairly substantial. They include intellectual property. They include issues dealing with business units located in the United States or around the world that might impact U.S. Operations. So there's a number of opportunities both for large and small firms as we, or mid-sized firms, as we look at the spending patterns a little bit beyond the overall marketplace. Now, what we wanted to do is take a look at spending based on practice areas. And what you see on your screen is the BTI analysis of the different practice areas and how they lay out for 2014. As you look at the chart, what you'll see is every yellow circle, every yellow, we'll call them bubbles sometimes, is a marketplace or a practice. And the size of the circle equals the amount of money clients spend on that particular practice. So if you look at litigation, that's going to be somewhere right around $20 billion or so. So you can do a comparison of the other practice areas. But what you'll see is running up and down the center of the chart is what we'll call the market rate. That is the average rate being paid in the marketplace. And if you look to the right, those practices that are to the right are probably going to receive higher than market rates overall. So what you've got is, as you look at the chart to the right, there'll be the opportunity for some relative premiums in the marketplace. As you look to the left, you'll see those practices to the left are going to be suffering more price pressure than those on the right. Now, in today's environment, we have to use the word premium with a little bit of caution. I don't think there's going to be 30 or 40% rate premiums, but there will be less price pressure on the right than there is the left. The reasons and the basis for those statements and projections is when we looked at corporate counsel needs, priorities, and sensitivities and their budgets and what they plan to pay, one can kind of triangulate those into the areas that are going to be receiving a little less price sensitivity, and that is the basis for the analysis. So as we look at this, we drew a horizontal line across the chart, and that is the growth rate that you'll see in spending for overall in the corporate legal environment. So we immediately know by looking at this, any of the practice areas, any of the circles that are above the horizontal line are going to grow a little bit faster than overall spending, meaning that there's a few new incremental dollars coming into the marketplace. Now that doesn't mean that it's going to be easy to get, but they're going to be a little easier to get than some of the other practices. The circles or practices below the horizontal line are going to be, shrinking, getting a few less dollars than the other practices. So we're going to have to work doubly hard to get market share in those particular practices. And this is really where we start to see differences and significant differences in some of the practices. So when you look at the horizontal and the vertical line, it splits the chart into 4 quadrants. The first quadrant we'll look at is in the upper right-hand corner. These are what we would call the priority practices. These are the places where you're likely to see better rates, and there's just a little bit more money flowing to these practices. The most attractive in terms of growth and rate opportunity all the way to the right is IP litigation. IP litigation is one area that has just continued to grow. Companies express deep concern over not understanding or not potentially being able to assess the full scope of the impact of settling or engaging in IP settlement talks. So they tend to be more aggressive in defending themselves, and the companies and organizations that are bringing the suits are tending to be more aggressive in pursuit. So you've kind of got IP litigation out there with higher rates, higher growth, and different behaviors than virtually every other practice that's on here. And that has been growing. Most of the law firms with IP litigation practices have been enjoying some degree of growth. So this will continue, we expect, over the at least the near term, and this remains a top priority for the corporate counsel community. Followed right next to it is class actions, which is going under a kind of reversal from where it's been over the last 3 years. If you looked at it last year and the year before, it was actually shrinking by 3 to 4% a year. It has bounced back up to grow between 2 and 3% a year. And what's happening is plaintiffs are getting more encouraged from an economic standpoint. And interestingly, what you've got is a couple of court decisions that have changed class actions the nature of class actions where the defendants feel as though these major decisions, the Concepcion and Walmart decisions in particular, have made it more attractive to them to defend, whereas the plaintiffs read these decisions as making it somewhat more attractive to bring class actions. So you've got interesting interpretations here, and these are driving the increases in class actions. As we look forward, as Target's data breach is in the news, prior to the release of that, our survey showed that we expect to see data privacy and security issues becoming an even bigger class action issue over the next year or so. So that's an area to watch for legal opportunities. M&A right behind class actions will continue to be buoyed by the middle market. Most of the M&A activity is in the kind of midsection of the marketplace. So these would be your startups, your biotechs, your technology, your product fill-ins where large companies are coming in and purchasing smaller companies to acquire a sales channel, a technology, a growth, or be able to get some other strategic benefit. Yes, there are a couple of large-scale, very high-profile acquisitions and mergers, but those are fewer and far between as they've ever been, with the bulk of the market again being in M&A, rather the middle of the marketplace. Slightly over to the left, you can see regulatory. This continues to be a kind of mini growth practice, and regulatory really is a very complex market in some ways to describe because virtually every company is subject to at least two sets of regulations. One would be industry-specific regulations, such as healthcare, financial services, even large companies and consumer products all have a set of regulatory issues that affect their products and what they do. Then they've got a set of regulations that sweep and affect all companies, whether it be things like wage and hour, whether it be financial reporting and SEC requirements, dealing with investors. So there's this labyrinth that clients just feel they're being smothered by regulatory aspects of and reinterpretation of regulations from every aspect of the regulatory world that they can think of. So in approaching this, it's going to be client-specific in terms of and industry-specific in terms of what their priorities are. But virtually every company is spending more money on understanding the regulatory environment. And this is characterized by smaller assignments, smaller questions, but often leads to large assignments in sometimes it will be litigation, sometimes it might be in investigations, sometimes it could lead to FCPA work, but really is at the forefront of talking about clients' unmet needs and upcoming needs, and can be a little bit of a dark horse because oftentimes some law firms overlook regulatory assignments because they can be so small to start with, but they mask a very large-scale opportunity. Moving down to the bottom right quadrant, we see a couple of things that, first the litigation, gigantic circle, bigger than anything else on here, really kind of flat to shrinking by about 1%. Clients have just been on a tear to find ways to settle, resolve, and otherwise get the cost of litigation down. And the reason for this is manyfold, including eliminating risk, but typically litigation will make up anywhere from 35 to 42% of the entire legal budget, followed by the next item, which is only 11 to 15%. So it's 3 times as big as any other line item on the budget. So if I'm a CFO and I want to cut costs, I'm going to take the biggest line item in the budget and just chop the daylights out of it, which is what is happening here. So you've got this litigation, you've got the marketplace, you've got a lot of work potentially coming in the door, but clients really hell-bent to just keep the cost down. So in order to gain share in litigation and get the new matters is going to require some new tactics we're going to talk about in a couple of minutes. But again, this is holding the overall growth in the market down, because if you can hold litigation costs down, you're holding a lot of your budget down if you're a corporate counsel. Bet the company is not a growth market, as we see corporate counsel trying to eliminate any kind of litigation, any kind of high-risk litigation. You've even seen, I think it was HESBC, which was very quick to settle some matters which were bet the company, and the CEO was actually criticized for it for settling too quickly. But that's the kind of adversity there is to engaging in bet the company matters right now. So we don't expect that to be picking up anytime soon. Now, if you go over to the left-hand side of the chart, you notice that there's really only one practice up there in the tactical practices that's showing some growth with a little bit of rate pressure, and that's labor and employment. And in labor and employment, we've seen that grow in a kind of increased growth rates for the past probably 4 years in a row. So if we looked at this 4 years ago, it would be sitting in the lower left and would have been shrinking. But between all the changes in regulatory issues, all the wage and hour, interestingly, the impact of social media, so not the regulation of social media as a company, but the fallout from social media where employees are using social media in ways that may be harassing other employees or may be putting and saying things that are inappropriate for the company to say in terms of discrimination, are landing up in the employment area. And that's just one of many reasons why that is increasing. Now, one of the reasons you're not seeing a tremendous growth in the rate premiums, in litigation you often have very large-scale matters as you do in M&A, but many of the employment matters tend to be small, so it's hard to get the economies of scale to justify a higher fee. So in the larger matters, you're going to be able to get a little bit of price premium, but as long as the matters stay a little bit smaller and higher in number, there'll still be a little bit of price pressure. Corporate continues to see a little growth. You notice we separate out M&A from corporate. As really the dollars that used to go to corporate, some of them have been shifted over to regulatory and compliance, trying to avoid issues as opposed to deal with them directly. Right behind corporate is intellectual property, which is the only circle that crosses, the only practice that crosses all 4 quadrants. And this has been a little bit of a tough market outside of IP litigation because you've got a sector of the market which is getting premium rates, and that's for counseling and finding clever ways to protect assets that weren't protected before or finding new protections. You've got your filings and your prosecutions, which are becoming more and more routine and subject to commodity pricing unless you're coming up with some different kinds of pricing. And then you've got other aspects which really bring together some conflicting pricing and need pressures on the part of clients. And we find the law firms that are doing well are packaging up those services so that they can meet all those needs together under some kind of bundled service to avoid the price pressure. But we continue to see a little bit of an uptick in spending, but not what we're seeing in the kind of robust fees that clients are paying in IP litigation. So we've got some opportunity out there. It's not like when we did this 5 years ago or 7 years ago when the markets were growing and the only question is how much can we grab out of the new spending. You can see, roughly, 2/3 of the spending is actually flat or going to contract a little bit, and then the part that is growing is only going to grow by a little bit, which really says we're going to have to hone our business development skills and try to find new ways to grab the new matters with clients, as we can't rely on new incremental business to come into the market to drive our growth. Now, as we're thinking about new markets and we're thinking about new growth, there is an interesting opportunity that seems to be presenting itself for those that are a little bit more aggressive. Clients told us that in 2014, you can see that they expect, if you look at the blue line, they expect the number of matters that they're facing to go up by about 63 matters. So that's a little bit over 1 a week. Now, you'll see the yellow line. Clients believe very much and are committed to keeping their litigation spending flat. So you've got this surge in the number of matters and spending which is going to be flat. That could be a conflict. So there's a couple of things and a couple of messages that we can take away from this. When we ask corporate counsel how they intend to keep their spending flat with so many matters coming in the door, their responses speak to aggressive use of early case assessment, aggressive use of budgets, aggressive enforcement of budgets, aggressive use of resolution and settlements, and finding ways to dispose of matters. So they're going to rely on all these tools to make sure that the matters either go away or they get resolved at a much lower cost per matter. So where is the opportunity for law firms? In our view, the major opportunity, and we think this is one of the best opportunities we've seen in a long time for new business with existing clients, is the fact that every new matter represents a new business development opportunity. And what we found is that a couple of savvy law firms have talked to their clients about this, as some clients, some corporations have already started to feel the surge. Now, what these law firms are doing is they've approached their clients and they've said, let's meet monthly, let's meet biweekly. And instead of waiting until you have this big backlog of matters you have to deal with, we're going to triage the matters as they come in the door. We're going to look at them. We're going to figure out the best way, perhaps initially, to handle them. We're going to figure out parameters, and we're going to lay out the different decisions that need to be made right up front when they come in the door on a regular and systematic basis. Now, the law firms that can sit down with their clients and discuss this new flow of business before they go anyplace else is in the prime position to A, get the work, B, become a much more valuable resource to their client, and C, has the ability to influence where the work goes. Now, I don't think in all our analysis over the last 13 years we've seen as many compelling reasons for clients to be sitting down on a regular basis to deal with these kinds of ongoing matters. So if you're in a position to sit down with your client and talk about these matters, because really this is only going to get done with your best clients. Many clients don't want to talk about these issues with law firms. They may like, but don't feel that they have developed that really, really top-notch relationship yet. But virtually every law firm has at least a few, and some have many clients where they do have that really, kind of mutually trusted relationship where they will sit down with you. And if you can do that, that's going to be your best both offense and defense, because you're keeping other law firms out while you're solidifying your position. Now, if you don't have one of those relationships and you ask one of your major clients to sit down and have this discussion, you've now at least redefined the relationship. You've informed the client that you're willing to make these investments, that you're thinking about the client, and you have the opportunity to change the nature of the relationship for the better. So you may not sit down biweekly. Maybe you'll sit down once. Maybe you'll sit down every other month. But if you can start communicating to your client that you're willing to make those investments, you will have differentiated yourself from at least 85% of all the other law firms out there. So we're seeing this as a significant opportunity that has not presented itself before, and are encouraging our law firms' clients to really take advantage of this and use this to your advantage. One of the law firms that is doing this is doing it under a very innovative alternative fee, where the fees are going to get applied to any litigation work. The two other firms are doing it on some kind of business development basis, and basically there are no fees involved. But this is happening as we speak, and something to think about moving forward. Now, clients also are going to be relying on settlements and resolution to help manage these costs. Right now, when you talk to clients, they will tell you that they have settled 40%, or they plan to settle 40% of their litigation matters that they came in the door in 2000, well, that are going to come in 2014 and that came in 2013. So you can see it spiked in 2010 and is really staying close to that 40% mark right from 2010 to present day today. So one of the ways, if I'm a corporate counsel, I can manage my litigation. If I can eliminate 40% of my matters, then I can help reduce my costs substantially, because that's almost half the matters. So again, this is going to be a tool, the opportunity being, how do I help my client reach a settlement process without making it look like I'm going to fold and I'm ready to litigate if I need to. Those law firms that can strike that balance and help their clients set up a decision-making or settlement framework will probably have an advantage of those law firms that aren't thinking that way. So let's talk about spending and where some of the money is going. What we did is, for the last 13 years or so, we have been tracking as a metric spending at the average Fortune 1000 company. Now, I'm going to talk about the average Fortune 1000 company, but if you go into the larger Fortune 1000 companies, what you'll find is that these trends are actually more acute the larger the organization that you are thinking about, and also are generally taking place in the middle market as well, with a couple of subtle differences that I will point out along the way. Now, as you look at each bar, say 2013, what you see is at the top $33.3 million, which represents the total spending of an average legal department at the Fortune 1000. 19.7 million, the blue section, is what is going to outside counsel. So if we go back all the way to 2001 and track that blue area, you can see that spending went from 10.5 million all the way up to 20.8 in 2008. So it almost doubled. And if we can all remember back, that was a pretty good time to be at a law firm, because money was just flowing. New incremental dollars were flowing into the marketplace, and you could get 6, 7, 8% growth without really stealing any market share or worrying about other law firms. As we all remember, 2008, 2009, the world changed. Spending went from an average of 20.8 to 18.5. It's over $3 million drop, about a 20% drop or so, depending on the time frame that you use to measure it, and has not grown by more than 2% since 2009 on a compound annual basis. So we've gone from high growth to very low growth. And there's a couple of important points to be made from this analysis. That if you look at 2009 to 2013, where it's only grown by about 2%, this tells us that any law firm that wants to grow by more than 2%, which is most of the law firms that we know of, will have to steal share from somebody else, because there are no new incremental dollars coming into the marketplace. We're calling this the continued predator's paradise, which means that in this environment, you are either a predator or you are prey. That is, you're either going to give up market share or you're going to gain market share, but there's absolutely nothing in between. And the goal, of course, if we want long-term success, is to be a predator. Now, as we also look at it, you can see we talked about the increase in internal spending. If we look over here at the green area, you can see this yellow line is the percentage of the budget that's going to outside counsel. So after 8 or 9 years of tremendous increases, hitting a high of 66% or so, we can see it's drifting down to 59%. So again, we expect that in the next 3 to 5 years to reverse itself, but over the short term, that's something that we have to deal with. Now, as I said, at larger companies, what you're finding is actually there may be absolutely no growth in the outside counsel budget and a little bit more added to the internal resources When you move into the more middle market and privately held companies, what you're finding is the outside counsel budget is still roughly flat. They're not increasing their budgets either. However, they have very little spending internally, so that budget is going to be totally dedicated essentially to outside law firms, but we're not seeing any growth beyond the 1 or 2% there. In fact, if anything, middle market clients are more aggressive in making sure that they settle their litigations, because as a privately held company, it has more of an impact directly on the shareholders, and they don't want to be spending money on litigation. They want to be spending money on revenue-generating items. So this reminds us we're in a predator's paradise. This reminds us that we have to steal market share in order to grow, and kind of sets the scenario of what we're going to be dealing with in 2014. And we think this predator's paradise is going to last at least for another 3 to 5 years, if not longer, but a minimum of 3 to 5 years. So as we're thinking about our strategic plans and our business development plans moving forward, this would be the driving notion. How do we steal share? How do we take share from other firms? How do we protect our client base? Now, this raises an interesting question, because we went out and we asked law firms to rate their own performance. So this is a self-assessment by law firms on their marketing and business development skills and their client service skills. So in a market where we can only grow by taking share from another firm, law firms rate themselves a 6.93 in business development, with a range you can see of virtually no skill to being extraordinarily skilled, but the average and the median being 6.93, very close to each other, so it's a nice even distribution. Now, I'm going to go out on a limb and say that at a 6.93 is probably not the skill level we need to be stealing market share. Probably need to be in the high 8s. So that's going to be a challenge for law firms, is how do we improve our marketing and business development? How do we get our partners more comfortable with it? How do we get it to be more of a natural phenomena? And how do we harness the rainmakers? We didn't have time to put it in today's presentation, but one of the things we found is virtually every law firm will indicate that, anywhere from 20 to 25% of their partners are truly excellent rainmakers, with 70, 75, or sometimes 80% maybe not having those skills. How to harness that 25%? How do we really get everything we can out of that in a market where, again, marketing and business development skills are going to become absolutely essential for long-term viability and for growth? And in terms of client service, a 7.82, while this may be on the lower edge of barely acceptable, with firms that are operating at a 9 and a 10, if we're at a 7.8, we're just not going to be able to compete. And at the end of the day, one of the things that hasn't changed is clients make their decisions on who makes and delivers the best client service. So by the law firm's own accounting, what we see, again, is another challenge on how we improve. And one of the ways that you improve is, of course, investing in your marketing and business development budgets. And what we've done here is shown you the trend in overall marketing budgets and business development budgets at law firms. You can see the yellow line is we'll call them the AmLaw Second 100. The blue line is the AmLaw 100, and the light blue line at the top are firms outside the AmLaw 200. So what you've got is you can see that the AmLaw, either 100 and Second 100, have both made substantial increases to their marketing and business development budgets. And what's also interesting, not only have they increased them, but they have changed the nature of these budgets. They have gone from being general to sponsorships and tables at events to being much more client-specific, almost doubling the budget for research, but increasing the budget for training and client-related marketing, client-specific related business development, where we're taking trips and educating clients, having specific client events on industry issues. Those are all where the new money is going, as well as to adding a couple of people. I believe the average law firm added 3 to 4 full-time equivalents in the marketing department. So we're providing more support to the partnership, as well as increasing our spending and focusing that spending more on clients. Now, outside the AmLaw 200, you could see that spending going down a little bit, and what they're going to be doing is, of course, is relying on their strategy and their tactics to try to outmaneuver the larger firms. So this will be one place, again, where we have a very keen eye in how law firms are investing and trying to overcome the perceived low scores and low performance levels in business development. So let's get back to clients and how this is going to apply. Well, one of the things we've been keeping track of is how many law firms clients actually use. When you walked into a typical corporate environment in a Fortune 1000 or large organizations, how many law firms do they work with on a day-to-day basis? What we found is that overall, clients are working with 47 law firms in total. But to be fair, the ones over in that represented by the blue column are handling small, routine, jurisdiction-specific matters. So we're going to take those out. We're going to just cross those out. We're going to make believe they're not there. So if we do that, what we've got is we've got 11 law firms that we have to worry about on a day-to-day basis. And why is it that we worry about these firms? Well, a couple of things. First of all, these 11 firms have roughly 80% of the outside counsel spending. So those other 36 firms only get 20% of the budget on average, and that's, not very much money. Second is virtually every one of these 11 firms has access to the top decision maker. They're all dealing with substantive matters. Now, to be fair, if you go to the secondary firms, what you'll find is some kind of rising stars, firms that are being very aggressive in trying to develop business and are investing in specific client relationships. You'll find 1 or 2 what we'll call fallen primary firms. That is, they used to be a primary firm, something happened in the relationship, and their caseload is tailing off, and they move from primary to secondary, and probably on their way to other and out the door over some period of time. But the 2 firms that are the primary firms, usually they're not equal. One of the primary firms is going to have somewhere around double the work of the other. Then you've got the second primary firm, then you've moved into the secondaries. Now, amongst those 2 primary firms, there's a couple of very special challenges. First, generally speaking, the client has very high expectations for that first primary firm. They've invested a lot of money, a lot of time, usually spending a lot of money and a lot of time with these particular law firms, and they expect a lot back in terms of client service, innovation, new ideas and alternative fees, new ways to do things, anticipating needs. They also expect the same thing out of their second primary firm. Now, as most people on the call today know, clients have this habit, and what they do is they take and they believe the last wonderful thing that you did is now my new expectation. That is, every time you do something wonderful for a client, it becomes the new standard. Now, the challenge that you have as a long-standing primary firm is you've done a lot of interesting things, you've done a lot of great things, and your client expects you to exceed those things every single time you deal with them. If I'm a secondary firm, I don't bring that history. And I may not bring as much institutional knowledge, but I have the opportunity, because I don't have the long history, to present new and different ways to demonstrate to the client that I'm going to exceed their expectations. So this is kind of a day-to-day war. Now, if we go into the middle market, what we find is, again, I feel badly for these 36 firms. These don't even exist in the middle marketplace. What you'll find is in the middle market that there'll still be 2 primary firms. There'll only be 6 secondary firms. So no matter where you go, unless you go to micro businesses where they're using one attorney who's usually a solo practitioner, you're going to find that every single day on a substantive basis you're competing with anywhere between 10 firms and 5 firms every single day. Now, what does this mean? Well, what I see in law firms is when there's an RFP or some kind of limited competition, oftentimes a partner will say, we're not going to let that other firm and fill in the name of the firm that would go in there. Some key competitors, they're not going to beat us. I've got this thing wired. I put so much time and energy into this. I've got this thing covered 8 ways to Sunday. And they're really going to be invested in developing this extraordinary proposal. That's usually what happens when we win and when we think about the competition. But very few partners in law firms think this way on a daily basis. They don't walk around saying, I am going to give my client the most thoughtful and responsive answer to a question that they've heard, not just today, but all week. I'm going to give my client the most insightful, easy-to-read deliverable that they're going to see this entire month. They don't apply the same level of adrenaline, the same competitive standard to the daily work. And the daily work is what's driving the ultimate decision-making. If we're bringing that level of competition to the daily work, then the new work won't go out to bid. It'll come to you. So we're urging our clients to think about the daily experience. What are your clients experiencing? What is the attitude? Sure, you're going to do great work and you're the best at what you do, but are we translating that over to the client? Is that showing up as being the best? And as the client, are we making a specific effort to do that? Unfortunately, we hear from clients that it doesn't often find its way into the daily responsiveness. So that's going to be the biggest challenge as we go through and try to compete, because remember, we can only grow by taking share from another law firm. And these, in the case of the public companies and the larger companies, these are the 10 competitors who want to take share from you. And in the middle market, these are going to be the 5 or 6 law firms that want to take share from you. So not only do we have a whole market we have to worry about, we have to worry about all the different law firms that are in our client base actively working for our client, because we know our clients are using these law firms. So this is a big competitive challenge and would be top of mind as I'm thinking through my client-specific strategies. And I'll just try to turn the page here, so bear with me. So as we're looking at these relationships, what we want to find out is first if we are the first primary core law firm. Some law firms know that they are the first primary firm. Others don't. The danger in not knowing is clients have certain expectations. If you don't meet those expectations and don't understand those expectations, then you're going to have a disappointing client. If we're the first primary firm, we have the biggest financial investment. Financial investment doesn't just drive profits per partner, and I don't want to undermine the importance of profits per partner, but as the market becomes more competitive, what we find is that the money to fund these new initiatives to gain share, like new technology, client feedback programs, training for the partners, all these things cost money, and the money has to come from somewhere. And that is the bigger relationships, the more profitable relationship will drive your ability to make these investments. At the same time, we want the client's emotional investment. This means that clients, even though they work with 8 or 11 firms, and this is true in middle market and in large companies, will make an emotional investment in only one firm, despite the fact that they work with 8 or 11 firms. They're only going to invest emotionally in one and really be better at sharing information, understanding where you're trying to head, and really having that one-on-one relationship, which is so coveted with our clients. Now, the other reason it's important is as clients are hiring law firms, especially when they're hiring a law firm they haven't worked with, 80% of the time they are going to go out to one of their peers. 80%. That is going to be the first step they take, and look for, feedback on a law firm. 57% of those individuals that are talking to their peers will hire the law firm that is recommended first. They don't even remember who gets recommended second. It's all about being recommended first. So if we can be recommended first by our clients in these peer conversations, that means we avoid RFPs, competitions, and all those nasty things that I know that we've grown to love over the years. But if we can get ourselves in the place where we have the biggest financial investment and the biggest emotional investment, that is the strongest state of a client relationship. That means that you are in the strongest place to build on that relationship. We call that clienttopia. That means that you're the first recommended and you're the biggest first primary. And if that's where you are, you're in a position to grow that relationship with a much better rate than virtually any other firm. So when we're thinking about that day-to-day combat and the predator's paradise, those law firms that have clienttopia relationships are much more likely to be the predator than the prey, and one of the reasons why we find it so central and so important. Now, as we closed out 2013, we found that only 31% of clients see themselves in this state of clienttopia. Now, in an interesting dynamic, when we talked about the primary and secondary firms, the biggest single reason that a corporate counsel or business executive does not recommend their primary firm is they don't have the same level of client service or commitment that the secondary firm does. That's the number one reason. Second reason is I feel like my primary law firm just, they're good, they do what I want, they do exactly what I ask, but they don't think about doing it unless I ask them. So they're not investing in the relationship, they're not looking forward, they're not thinking about my future needs. In about 5 to 6% of the cases, we hear about being too expensive. So that leaves 95% of the market that is not satisfied because of rates, and really leaves the challenge of opportunity, because if we're a law firm, first of all, that 31% is not evenly distributed amongst all law firms. There are law firms that have much higher rates of clienttopia than others, and they will have an advantage, and those that can figure out how to get into a state of clienttopia are going to have an advantage, which is driven solely by, client service. Now, I'm hoping everyone on the call today knows that there are 17 activities to drive client relationships. Because of time today, I'm not going to spend nearly as much time as I would like talking about all 17 of these activities, but we will be having another webinar, and which we'll be announcing shortly, where we're going to discuss nothing but the 17 activities. So I hope you'll all make a note to join us for that. But just briefly, if you look at the 17 activities, we came up with the 17 activities through some extensive research with clients trying to find out what they think about when they select and evaluate a law firm and professional service firm. We asked how important it is, which is on the bottom axis, the most important activities being on the right. But when we asked the importance, clients were quick to tell us that that's not always a good indicator. What they said is something may be important, but it may not really, I may not give it that much weight because I expect a law firm to have this, and it doesn't really make me lean towards one firm or another. So we started asking how much it differentiates a firm, how scarce it is in the market, and that is over there on the vertical market, vertical axis over here. So what we did is the line running up and down almost the center of the chart is the average for all 17 activities. Then the horizontal chart is the average for differentiation. And to make a long set of mathematical equations short, the activities below the line are those that don't differentiate a professional service firm or a law firm. They are expected. The activities above the horizontal line are, in fact, the activities that will differentiate a law firm. So when you put them on the different axes, the different quadrants, you find, again, different roles for the different activities. The activities in the lower right we call the price of admission. You can see legal skills is the most important activity, but yet well below the line, because clients will tell you categorically, between the 52 law firms I work with, between the 8 firms in the private and middle market segment, if you look at my law school peers, if you look at all my colleagues, I can find the legal skills that I need. Those things like meeting scope and keeping me informed are all requirements, and if you don't bring those to the table, I will not consider having a relationship with you. But in the upper right, what you've got are the real differentiators. These are the things that separate one law firm from another. And the most important influential activity, more important than quality, is commitment to help. This is the idea that you, in fact, have more energy invested than everyone else. That is, you are the one that is going to be the first to respond. You're going to respond with more energy and vigor than everybody else. And if you want to understand commitment to help, it is highly individual. It is the highly subjective judgment at the end of the day that every client makes that says, are you here to bill hours, or are you here to help me really solve my problem? And the law firm community, in balance, continues to send messages, although unintended messages, to clients that they're not as committed to help as we know they are in their hearts and their minds. Because clients want to talk about how we're going to change work processes, and law firms want to talk about how they're going to change their rates. And clients want to talk about how they're going to get more value, and law firms want to talk about their rates. Clients want to learn about new regulations and new structures for deals. And some law firms send out e-alerts to keep their clients informed. Some partners in law firms make phone calls to their clients to tell them about the new regulations or the new deal structures or new laws that impact them. And then a very few law firms design very customized presentations for their clients, and will go visit their clients with their top partners and brief their clients for anywhere between 1 to 3 to 4 hours. Some will even have facilitated planning sessions about how to deal with the impacts of the changes that they're talking about. Now, of those 3 types of law firms, which do you think shows the most commitment to help? It's going to be the last. It's going to be the ones that make that individualized kind of analysis specific to a client, concierge-level service, concierge-level understanding. If you're tracking your clients' news bulletins, that's really, really good. But the lawyer that reads the executive-level job postings for that same client to find out when they're going into a new market, when they're even hiring a new general counsel, when they're adding someone to their IP staff, those are the firms that are showing the commitment to help versus everyone. And the question is what extra step do we have to take to show that commitment to help? The next important is value for the dollar. Value for the dollar, again, I keep getting questions, isn't this code for low rate? And when you see the BTI Client Service 30 in a couple of minutes, I think we have evidence that says that it's not code for low rate, so we'll defer that. Client focus is the ability to meet clients' objectives, not the ability to do the best job, but to meet clients' objectives. That is, do we know how to settle? Not do we know how to litigate will be just as important. And understanding the client's business, because clients want all their advice in the context of business so that they know and can tell their CEOs and their bosses what the impact of the decisions are going to be. Before we leave the 17 activities, I just want to point out the 2 activities in the lower right, because these are statistical anomalies. Anticipating the client's needs and innovative approach. These 2 activities are magnets for new business. They are statistical anomalies because roughly only 65% of clients see them as important, but these happen to be the 65% of clients that are the least price sensitive and have the most complex issues in their businesses. So they're very attractive clients, and they use the innovation and your ability to anticipate their needs as an indicator of an individual or a law firm that is much more forward-thinking than everyone else. So in an ideal world, you're using your innovation to be able to attract clients, and then using the skills in the upper right to keep the client relationship growing and enjoying higher rates while you're doing it, because those 4 activities have some statistical links to higher rates and growth that, again, we'll be talking about on an upcoming webinar. These 17 activities form the basis of our annual survey, where we go out and we say to clients, who is absolutely best at each of these 17 activities? We want to know by name. We only ask who's best. We provide no lists, and we provide no prompting. Now, this year we heard about 336 law firms. 650 firms serve the Fortune 1000. So it's just about a shade over half of law firms serving the Fortune 1000 don't even show up for some aspect of client service. Were I competing, this would concern me greatly in a market where you can only grow by taking share, and clients make their hiring decisions based on client service. Now, as you move to the left, what you can see is 306 firms are identified in some way by clients for some aspect of client service. As we move up, what you can see towards the yellow is there's more and more client service activities that clients recognize for a given law firm. Finally, we get to the BTI Client Service 30. These are the best performers. Statistically, they are 8 times better than the average law firm. The range is 5 to 15 times better than every law firm. Now, this year's BTI Client Service 30 is a very interesting Client Service 30. What you see, Skadden is number 1. Congratulations to Skadden. And they have been gradually moving up the ranks for the past 4 or 5 years, and finally crept into the number 1 spot, so good for them. Jones Day, number 2. Sidley Austin, number 3. And Morgan Lewis, number 4. Now, all 4 of those law firms have been in the BTI Client Service 30 for 12 years or more. Now, as you look at it, what are they doing that is different than other firms? But before I answer that, there's a couple of other things I'd like to point out. First, if you look at the BTI Client Service 30 beyond the top 4, you've got Kirkland, Mofo, Latham, all of which 1 through 7 you could characterize as some form, if not substantially global firms. And then you've got Thompson Hine Fagery, more U.S.-centric, substantially smaller firms. Then we get back into some more globally oriented firms, and you can see that we've got a mix of both. One of the things, we talked about this on our blog post just yesterday, themadclientist.com, that one of the things we've seen happen and evolve over the last 18 months or so is that the larger firms, the globally oriented firms, have realized that placing the same amount of emphasis on clients as they did building out their global networks was, essential to growing and gaining and adding to their market share. So initially, many of these firms, while they still had good client service, were focusing on how to build out their global networks, how to grow, how to add the offices, the laterals, and the infrastructure. But again, about 18 months ago, what we saw is this kind of renewed interest in looking at the global view, but taking it on a client-by-client basis and saying, how do we deliver superior client service to our individual clients wherever they be, while we continue to develop this global presence and this global practice? This combination of being able to put client service at the forefront has really changed their performance, because if you look at the top 3 or 4, Jones Day, who has been number 1 7 years in a row, went to number 2, so they're still an extraordinary performer. Skadden managed to move up. 5 years ago, they were just at number 30 or so, and now they're number 1. Sidley moved up about 12 spaces. Morgan Lewis moved up from number 25 or 26 up to number 4. So you see these, really dramatic improvements in performance. You saw dramatic improvements with MoFo, with Kirkland and Ellis. So, that's really had a dramatic impact on other firms because as living proof, Thompson Hine and Fagery can still clearly compete at the client service levels of the global firms. But it put a number of smaller firms or mid-sized firms at risk because they were relying on their client service, and what happened is the global firms leapfrogged the mid-sized firms in client service. It's not about the growth, it's not about the size, because the client service superiority is coming from individual clients. It's not necessarily their global breadth, but the individual client in an individual office or across the firm that's receiving superior client service. This is being done on a one-by-one-by-one basis, a client-by-client basis. And we believe this is the start of the next set of kind of strategic initiatives that you're going to see with law firms. If you go to, the big four, if you go to the investment banks, if you go to the big management consulting firms, they all look at their clients certainly as groups, but they look at them as individual markets. What can we sell to this client? How should we be marketing to this client? Now, clearly you're only going to do this for your larger clients, but this has been essential to the dramatic growth of professional service firms outside of law, and this has been the first indicator that we're going to see it starting to be applied to law. What's interesting is we hear the same feedback for the more U.S.-centric and smaller firms like the Thompson Hines and the Fagerys, the Hush Blackwells, who joined the BTI Client Service 30 for the first time this year, so congratulations. But we're hearing about that individual client approach, and that's being really effective. So this will be the new level of competition as we move forward. Now, one of the questions we've gotten in every webinar and every breakfast that we've had in New York is, okay, why is there change in the BTI Client Service 30? So we tried to get ahead of the question, and we did an analysis here. You can tell the orange, as we discussed, have been on the BTI Client Service 30 for 12 years or more. The yellow have been on the BTI Client Service 30 for 6 years or more. So this means that roughly 20 or 2/3 of the BTI Client Service 30 have been here at least 6 years. So when you look at it, one starts to see Well, hello again. Appears the telephone line got lost in the shuffle, so I am back. And what we were discussing was the patterns of client service and how we try to anticipate the question of law firms becoming part of the law firm culture. Roughly 2/3 of the BTI Client Service 30 over the last 13 years have been repeats in some form, shape, or manner. So clearly, setting themselves up for a client service advantage, but still leaving room by the firms that are in white text to be able to, find ways to deliver client service in new and innovative ways and leapfrog the competition. So this will be interesting to watch as we move forward. Now, we're often asked, certainly we get intellectual reward from delivering superior client service, but what are some of the business reasons we'd want to do this? Well, first, if you're a secondary law firm, you're typically delivering one practice. If you're a primary law firm, you're delivering 1.8 practices. And if you're a primary law firm with superior client service, you're delivering 3.2 practices. Now, again, I hate to sound like a broken record, but this is a market where we can only grow by taking share from another law firm. So by delivering superior client service, we can improve the number of practices we are delivering, capture that extra revenue, keep law firms out of our client base, and drive growth for ourselves. In addition, those firms with the best client service enjoy 33% higher profits, rate premiums, get twice the fees from a single client, sometimes more, roughly 40% higher client retention, and 36% higher growth than other law firms. That, by definition, will get you that extra market share that we need to grow and thrive in this marketplace. Now, we had a couple of questions when people registered. One of the things they really wanted to know was, how do you get buy-in for a client service initiative? And we just thought we would share three. One is, first, making somehow the client service initiative the partner's idea and getting their enthusiasm around it. So doing things at your retreats and your partner meetings, like asking partners to rank the priority and benefit of various client service tactics, which would be the most important, the least important, which would have the most impact, and use those results to inform and design your initiative. You can certainly add your own experience and insight into this, but this will bring the partners into the process as opposed to just mandating a process. If you do something like this, you can use your next retreat to create the demand. We've been very successful in helping our clients design breakout groups to drive client service, where the partners themselves identify the obstacles to client service. They then go through a breakout session to overcome the obstacles and identify the best actions to implement. What's very powerful about this is you get your partners focused on the obstacles themselves, overcoming them, and the entire partnership has vetted the best actions to take, and then you can prioritize them based on your experience, your observation, what you think will work for the firm. When you have these kinds of breakout groups, we found very much more effective if you make them short as opposed to long, if they're specific, so we don't talk about things like our obstacle is, well, we don't have the right compensation. They're specific, like we don't have the right tools, we can't meet with our clients. Have the actions vetted by the partners so that everyone gets to take a look at them, and really avoid the kind of navel-gazing questions like, what's your vision of client service? Well, let's not talk about visions of client service. Let's talk about what we would do on Monday. If you were with a client Monday at noon, what would you be talking about? If you could do one thing, what would you be doing to improve client service based on all the things that we know improve client service? We've also been asked, how to, again, if you can provide the evidence that you need to outperform your competitors. And the only way we know to do that is to get client feedback on both you and how your competitors are performing. You can use an overall performance score. You can use BTI 17 activities. You can ask your clients to rank your firm against other firms. using the metrics to put a stake in the ground and put them in front of the partners to say, this is where we are, this is where the competition is, this is why we have to either close the gap or make the gap bigger, and probe as to why, to help the partners understand why they're being ranked differently than other law firms. This works in about 85% of all cases because very few partners of law firms see themselves as even equal to competitors. So if you get a ranking that's anywhere near close to another law firm, you're going to have a partner motivated to really improve their performance. How do you get support for the client feedback? Again, creating a sense of urgency, include metrics in your strategic plan, your partner goals or practice goals. We recommend getting feedback from high-profile, large-scale clients first and getting the feedback back to clients within 5 to 6 days of conducting an interview. This creates the kind of excitement. Ask the partners what kind of questions they think make the most sense to ask clients. Go with the partners who are more friendly and influential to the client feedback process, and invite partners to present the changes that they've made and resulted from client feedback at every firm-sponsored meeting. This includes the executive committees, the practice committee meetings, the practice-wide meetings, office meetings. Build 5 minutes into every single meeting, and all of a sudden, it's a complete part of your culture. A negative reason to do it, but just as important, we found that in doing research, the average AmLaw 200 firm in their top 50 to 100 clients has 11% of total firm billings at risk. They found situations where they just didn't realize that clients weren't happy or there was a change or something was moving in a direction against them, and that alone would drive someone to do client feedback. And finally, what I'd like to end with, since we've been talking so much about market share, is who's gaining market share and who isn't. What we did is we looked at 2 key aspects of performance. The first is we looked at over 200 law firms and we said, okay, what is their 3-year growth? And we use 3-year growth so that we eliminate 1-year jumps and anomalies and things like that. And we said, if they're growing faster than the market, this horizontal line right here is the growth in client spending. So if you're growing faster than clients are increasing their spending, you are gaining market share by definition. If you're not keeping up with client spending, then you're losing market share. And we found law firms fit into 4 categories. The leaders are gaining market share and have superior profits. The bottom axis is profits per attorney on a rolling 3-year basis. We use profits per attorney because that is the raw profitability that feeds profits per partner. And we want to look at the core profitability. So the leaders have higher profits. The average profits per attorney run down the center of the chart. So anyone on the right has higher profits. Anyone on the left has lower profits. So the leaders have higher profits and are gaining market share. So it's kind of like a business perfecta. This is where we want to be. The harvesters have superior profits but are giving up market share. The investors are gaining market share at a greater rate than many of the leaders but have lower profitability because they are investing in activities which will get them over into the leader quadrant. And then we've got the followers who are losing market share and also have lower profitability. The circle size represents roughly the percentages that you'll see of the different law firms in each category. Just to make it more interesting, we thought we'd share some names. Now, one of the things that we found is that when we talked about providing value, is that really code for low rates? Well, let's look at the firms that have superior profits and are gaining share in the upper right. You've got firms like Kirkland, Latham, Sullivan and Cromwell, Morgan Lewis, Sidley, Covington and Burling. So clearly, firms that sport healthy rates and are managing to gain share. So it's happening in today's marketplace, measured on a 3-year basis. When we look at the investors, what you see again is these firms have made a decision that they're going to be investing in some aspects of their infrastructure to try to improve their performance. And what's interesting is if we looked at Morgan Lewis and if we looked at Sidley Austin, 4 years ago, they would have been investors, and they've managed to translate that over to being leaders. So what the firms over in the investor quadrant are doing is they are bucking and betting on the fact that they're going to get themselves over into the leader category by making these investments that they are. The harvesters, will figure out at some point that they need to grow because they're very smart and very profitable firms. They will, if they lose too much market share, they will merge with a leader or an investor, and the followers probably would be well advised to revisit their strategy as, every year that passes makes it more difficult to be able to gain share and improve profitability in today's marketplace. A couple of rules for market share gains. 70% of those firms that are in the leader or the investor category have superior client service. Not good, but superior. Assign a senior partner to be accountable for client service. Don't dabble, commit substantial resources on a regular basis, not a one-time surge, but systematic. We've already talked about treating your 50 largest clients as markets of one, and act now. We're only at the beginning of the maturation of the legal industry. We have a long way to go. Immediate impact activities, we talked about forming a triage team with your clients to assess new matters and needs as they come in, whether it be once a month, biweekly, depending on your client, sitting on new product development committees to help spot IP opportunities and some regulatory opportunities a lot sooner than you might otherwise see them, and swarm clients with online value-added tools like checklists, guidelines, self-assessments. Clients are loving these kinds of things, and they really, really add tremendous value from the client perspective. Now, just to kind of wrap things up, we've got some new reports in the works, so I hope you'll all be looking for the new BTI Client Service All-Stars, which will come out in 2 weeks. We have a new report on the IP and IP litigation market and a rate study coming out, and we have a new update to the Brand Elite. And as you all know, we just released the A-Team, the Strategic Review, Premium Practices Outlook, and the BTI Litigation Outlook. Anyone wanting to discuss how we might be able to help or you think about developing client feedback or client service initiatives, you can contact either Jennifer or myself. We will be at the LMA Annual Conference on Thursday, April 3rd at 4:15, so I certainly hope that you'll join us there. And then I would like to thank each and every one of you for joining. We have virtually everyone on the phone that started with us way back at noon, and we all hope that you'll stay in touch with us through the Mad Clientist, where we continue to increase our activity and share more market insights with you. So I hope you'll join us there and reach out to either myself or to Jennifer with any questions and thoughts. And we would like to again thank you for joining us this afternoon, and you'll be receiving a link and an evaluation and a ability to download today's presentation, and we'll look forward to announcing the next webinar shortly. Thanks so much again. Bye-bye now.